Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Interest rates seem to be in a flux. Oil prices are at multi-year highs and inflation seems to be rearing its head again. On the other hand, below than expected GST collections have given rise to worries about higher fiscal deficit. Now, all of this is usually not great news for the bond market, and you would have surely caught those recent headlines talking about surging bond yields. And that has been quite a story of 2017. The benchmark yield, which was at a low of 6.4% in July 2017, hit a high of 7.4% in December last year. That's an entire 100 basis points move. So, what does all of this mean for your fixed income investment? Do rising yields mean higher interest rates? What about your fixed deposits? What about your debt mutual funds? What is the safest bet to be in the fixed income world given all of this volatility around us? Well, we're dedicating this entire episode of Money, Money, Money to answering exactly those sort of questions. Joining me to get us those answers is the Managing Director of the country's largest PSU bank, Mr. P.K. Gupta of SBI. To give us a perspective from the debt mutual fund standpoint, I have with me Amit Tripathi, who is the CIO Fixed Investments at Reliance Mutual Fund, as well as Dwijendra Srivastava, who is the CIO Fixed Income at Sundaram Mutual. Gentlemen, thank you so much for taking out the time, and thanks very much for joining in. Now, Amit and Dwijendra, lots of questions because, this is the time when retail investors have really started looking at debt mutual funds. Everybody knows the fixed deposit 6% is not good enough. But before we start talking about that, let me actually get in the banker. Let's see what SBI's sort of outlook is on interest rates. So, Mr. Gupta, thanks very much for being with us on the show today. Let me get your first thoughts in. And the first question is a pretty simple one, There's a lot of talk, as we just sort of outlined, whether it's inflation, whether it's crude oil prices, fiscal deficits, and those yields are moving higher. What does that mean? What can we expect on interest rates this year?
No, I think as far as the interest rates direction is concerned, I think that the downward cycle in the interest rates is practically over. You look at the inflation, the CPI is at 4.88%. As you know that the RBI has been looking at 4% as their target CPI. Okay, so even though really, they talk about plus minus 2%, but I think really what they are targeting is 4% inflation. Given that as the objective of RBI, so we don't really see any downward movement in the interest rates happening. In the past, there has been a lot of liquidity in the market, which actually kept the interest rates low, in the bond market or in the general markets also. But a lot of that liquidity has since got used. But still there is some liquidity in the market. I think about 100,000 surplus is still there in the market. But most of this probably has now come on account of maybe the RBI's operations in the forex markets, where probably they have been mopping up some dollars from the market. And that is what the Deputy Governor Viral Acharya also indicated in the last monetary policy press conference also. So I think as long as that liquidity still exists, so we don't really think interest rates moving up actually. But I don't really see any downward movement in the interest rates happening anytime soon.
Okay. So, sir, does that mean that you are expecting a longish pause by the Reserve Bank of India? I mean, how long? What, the first half of 2018? That no move from the RBI?
Yes, I think I would believe that we would have longish pause, because I don't really think that the scenario as it exists as of now warrants an increase in the interest rates. So we are probably in for a longish period of pause on the interest rates. I think interest rates should remain stable around the current rate for quite some time now actually.
Okay, so then let me boil this down to your customers, the bank's customers and our viewers as well. What can borrowers expect with respect to rates both on the borrowing side as well as the deposit side? So if there's a pause from the RBI, should we expect stability?
No, I don't really think that there should be too much of changes happening there also. See, we did cut our base rate effective 1st of January, but that was the cumulative effect of whatever the interest rate changes that the bank had made in the last quarter. So the impact of that got passed on. As far as the borrowers are concerned, I think if you look at the interest rates, they are probably at the lowest level, okay, as compared to many years in the past. So I think they should continue to take advantage of the low interest rate regime that exists. Will the interest rates move substantially higher from here? I think again probably it will not happen in the near term. The bond market and the bank, interest rates on the deposits and the lending side, I think we must look at it how they operate. So both these markets operate totally independently. So as the markets don't really expect RBI cutting rates further, so I think the bond market has corrected. So the overall yield curve, which had practically become flat, has now steepened a little bit. So as I don't expect a lot of movement happening on the interest rates on the deposit side, so I don't really think that the lending rates also will get changed.
Okay, so fair enough. Got your point. You're not expecting any kind of a major rate hike and stability on interest rates. But the fact is that FD rates are very, very low. And that has been prompting a big shift towards debt mutual funds. People really want better options, more tax efficient returns, higher returns. And that's a trend that we've begun to see. So your thoughts on the same?
No, I think we do believe that the customers must make use of all the investment options that are available. Okay, and even as a bank itself also, we have a lot of customers who have a lot of surplus money which lies with the bank. Okay, so the bank FDs do offer a lot of flexibility to the customers in terms of how they can use it whenever they need the money, they can draw it. But at the same time, particularly for the customers who are at the highest tax paying bracket, for them it does make sense to invest part of their portfolio into the mutual funds also. And even the debt mutual funds, actually with the indexation benefit that is available, does give a better yield to the investors as compared to the bank FDs also. So I mean, even though as a bank we probably end up losing some of the deposits, but I think we do advise customers to park some of their funds into the mutual funds also.
All right, Mr. Gupta, thanks so much for being with us and taking us through your expectations on which way interest rates are heading and what depositors and borrowers can expect from SBI and big banks like yourself as far as this year goes. Well, now let's take the conversation forward, and that's really the question. If you're willing to go beyond the fixed deposit, if you're looking at better returns, then how do you go about building your fixed income portfolio? Amit and Mr. Srivastava, that's really the central point, right? To try and understand that when you want to make that shift, looking at the flux in the market, Amit, where does one even start? I mean, is it important to first set your time horizon, whether it's 1 year or if it's 3 years, if you're looking at the tax advantage?
Yeah, I think tax advantage is definitely one of the bigger incentives, at least for first-time investors, to start looking at mutual funds. But I guess what one should really concentrate on is the efficiency of the investment per se, and obviously marry your investment to the time horizon that you're looking at in terms of whether it is 7 days, 1 year, 3 years, 5 years, whatever be the time horizon.
Absolutely.
So I guess picking the right product to match your time horizon actually removes a lot of the so-called risks that are associated with capital market instruments,
Sure.
Specifically with mutual funds. So if you have the time horizon right, we typically believe that a lot of investors will always exit with a very positive experience as far as their investments in mutual funds are concerned, debt mutual funds specifically.
Okay, so that's really rule number one, that
Yeah.
make sure that you know what is your time horizon, for what purpose do you want to park your funds, for how much time, and then the process of choice begins. Mr. Srivastava, let's get your thoughts on the market per se before we start talking about the sort of funds. You just heard one view from SBI. They're not expecting anything dramatic from the RBI, not even a rate hike, as the market, though the market seems to be worried. What is your own reading?
So I think I would agree with the SBI in terms of the fact that there could be a longish pause before RBI actually moves on the rates, and probably the movement should be on the upward side. When we look at, we have to put things in context of both domestic as well as global factors.
Sure. So, Amit, your reading on this, just purely the rate cycle. Is there a hike coming? If yes, by when do you think we'll see that?
So if you look at market pricing in total, so 3 or 4 points. One, market is definitely not looking for any rate cuts in 2018. Market is fearing rate hikes in case the commodity cycle, especially oil prices, continue, and it puts pressure on core inflation going forward. Market is also expecting a very buoyant growth cycle to continue globally and India to catch up in 2018. And somewhere around the line, even for developed market economies, market is expecting inflation to catch up, right? So whatever we have seen in the market in terms of movement is a combination of all these factors coming in terms of yields. Sure. And hence there is some discounting of that fact that if there is a deterioration in macro fundamentals, whether it is on inflation or fiscal deficit side, then there would be chances of rate hike sometime towards end of 2018 or
calendar year 18.
Yeah, calendar year 18 or thereabouts.
Okay. So the fact remains that at some point in time in calendar year 2018, we might look at a rate hike from the Reserve Bank of India, something which the bond market is already pricing in. What does this mean for your mutual funds on the fixed income side? The conversation continues after this short break.